This is David Roach, Quantum Economics and Independent Strategy. Today, I want to talk to you about the shape of things to come. That is, the shape of this economic cycle, because it is like no other. And I call this shape sawtooth. Now, first of all, let's think about what makes up a normal economic cyclical recovery. Well, you will know from your reading that they can be called L-shaped, U-shaped, V-shaped, and so on, a few letters of the alphabet. But they all have one thing in common. They rejoin a trend line or do not rejoin a trend line and stay below that trend line. So picture that for a second. The trend line of GDP or output or demand in general, we're approximated to well-being, provided it is material in origin, extends across the page of history, so across time into the future in a gently, in mature economies in any case, rising line, indicating that as we go forward, the trend of GDP actually leads to increased levels of output. That's the way the graphic looks. So the vertical axis is the level of GDP, output, happiness, welfare, however you want to term it. And the horizontal line is time. Now, when you have a recession, the actual line, and think of it in a different color, it's easier to visualize, it dips well below the trend line. And then when the recession is over, it rejoins it, or at least moves towards it. Now, sometimes it will be a slow recovery, which is the L-shaped recovery. Sometimes it's V-shaped, which means it bounces back to trend growth pretty quickly. And sometimes it's U-shaped, which means the bottom is a little bit more prolonged of the recession, but it nevertheless moves back to trend growth. Now, interestingly, after the great financial recession, the trend line moved back in the sense that it paralleled, more or less, the previous trend in output, but it never quite got there. It continued on through history, paralleling, being close to, but not at the trend line. So there was a permanent loss of output. That's the classical kind of, at least visual theory of economic recoveries. Now we come to what we're going through now. And it is very different. And that's why it's kind of a quantum economics decoherence idea, because it means that the past history is not very much guide to the future. What we're seeing is this in the sawtooth recovery. We're seeing recovery that is demand, and in some cases supply, and in some cases supply, not demand, bounce back extremely sharply, like the edge of a dog's tooth, breaking through the trend line and moving well above it. Then it declines to the trend line. Now, what is driving that sort of pattern, which actually is pretty prevalent for countries and for sectors, for different demands of goods and services, and for different output sectors of goods and services? What is actually driving that shape? Well, again, we have to step back into the pandemic and think about things. There are two things we need to think about. First of all, ironically, corporate and household balance sheets got stronger, not weaker, in the pandemic, even though theoretically unemployment or furloughed workers became a very large proportion of the workforce. They got paid directly and indirectly by the government. And secondly, they couldn't spend all that money, so a large proportion of it got saved. So when you look today, their balance sheets are very strong. And what is very interesting is their level of deposits, that is holding that money in short-term savings, is very strong. So in other words, this money, once normalcy resumes or some level of fear of the pandemic actually subsides, this money gets spent. Not all of it maybe, but a lot of it gets spent. And this produces the very abrupt, saw-toothed recovery in demand in many cases. And that demand, for instance, if you couldn't buy something you wanted during the pandemic, and now you can, you rush out and you buy it. So demand for that product goes from 0 to whatever it is, up by 100%. And that feeds into the saw-toothed demand. Now we have to think about what happens next. In many, many of those sectors which are experiencing this saw-toothed recovery, you actually go out and buy whatever you couldn't buy, but then you bought it. Let's say, and we'll return to this as an example, you wanted to buy a car during the pandemic, but you couldn't. Or you wanted to extend your house because you discovered that working at home was really rather nice and the house was rather cramped. So you want to extend your house, but you couldn't. And now you can. So you go out and you satisfy your needs, or at least your desires for these things. But once you've done so, you don't do it again. So after you've done it, demand for those products will fall. In other words, the saw-toothed demand, the upside we're going through at the moment in many cases, many products, and the downside comes once that initial need or desire is sated and you can't sate it again. Then the decline to trend growth actually implies a period of negative growth, a period in which demand actually shrinks, like you were in a recession, but you're not. You're actually just returning from an excessive level of demand to a more sustainable level of demand within an overall economic framework. Okay, so that's very simple. You can probably imagine a lot of products where the saw-toothed demand will apply. There are other products where it applies for a different reason. Let's say, for example, during lockdown, you ate a huge amount of takeaway meals or home delivery meals, put it that way. And now that you're not locked down and you may have returned to work at least for some days a week, or you may be going out to amuse yourself in restaurants or cafes, or if you happen to live in the UK, which I don't, pubs. So you're not having as many takeaway meals at home. Now, that actually implies two forms of saw-toothed demand. One is that demand for delivery drivers, takeaway meals, falls to a trend line which was there probably before the pandemic. And secondly, the demand for services like dining out rises, and rises very precipitously. So on the one hand, you have a saw-toothed demand drop for the services you use during lockdown. And on the other hand, you have a saw-toothed demand for face-to-face dining services outside. So the saw-toothed demand actually works both ways, but is relevant to analyzing each sector. It also applies to countries. For example, the US pumped an unprecedented amount, something of the order of 35% of GDP, just in pandemic relief into its economy. And the result was that it was the first global economy to really recover. So it led the world in terms of growth. And Europe, for example, and Japan even more, lagged the United States. So the saw-toothed demand in the United States is very clear. The United States economy is experiencing growth rates on a quarter-on-quarter basis, which, if boiled down to what they signify annually, are approximately 7 to 8%. Now that's unsustainable in an economy which is, after all, a grand old lady with a sustainable productivity level of probably 1.5 to 2.5%. So that growth rate, that over-consumption, over-investment, which is inherent in the saw-toothed demand on the upside, will go over the top of the mountain and down the other side of the mountain into the valley, where it will rejoin trend growth rate. And during that period of time, the US economy will no longer be the world leader in terms of growth. It will actually probably be a laggard and experience very weak, if not negative growth on a quarter-on-quarter basis in many sectors, and quite possibly at the aggregate macroeconomic level. On the other hand, countries, areas, blocks, to put it more specifically, like Europe, are now staggering their way, despite the Delta variant of COVID, staggering their way out of the pandemic recession. Government stimulus, particularly the EU Next Generation Plan, is not only boosting productive investment, green investment, communications investment, internet investment, and so on. It's also, of course, boosting confidence. And so the European economy is probably going to experience a recovery, which is an exact mirror of the sawtooth demand we saw in the United States, except it is happening later. And of course, then you have Japan, which has made a staggering mess out of COVID, pandemics, vaccinations, and everything else, including the Olympic Games, in my view, and will probably prove the biggest laggard of all until we get close to the next diet elections and leadership elections, which are scheduled, which are inevitably going to happen next year. And then, of course, Japan will spend a lot more fiscal money, as it always does, to no avail in a lasting sense. But it will then, itself show the sort of growth rates which put it at the top of the sawtooth demand pattern. So essentially, if you think of this in visual terms, the United States is right up the red line to the top of the mountain, is going over the summit and is going to decline towards trend growth rate. Europe is going to be the next leader. And after that, it'll be Japan. And then we can argue about the emerging markets, which I think will experience little sawtooth demand patterns, but they will be very weak going forwards because of the implications of ongoing COVID infections, ongoing pandemics in emerging markets and developed economies for world trade and other things. Now, if you were to look at the last conclusion you can draw from sawtooth demand, it is this: the world was led out of the pandemic by manufacturing production. Partly this was to do with an inventory cycle, but actually it was mainly due to a great boost in demand from this stock of savings and financings provided to individuals by the government, a great boost in demand for manufactured goods. And the reason the boost in demand for manufactured goods was partly due to changed circumstances. For example, people were working at home, so they needed a decent computer. Their crummy webcam camera like mine was just not good enough if you're an investment banker from a large international bank working at home. So they all bought new stuff to work at home. And that boosted, of course, technology, demand for technology hardware and software dramatically. So that is why manufacturing demand and the manufacturing supply, constricted as it was in terms of international trade, led us out of the pandemic recession. What did not lead us out was, of course, services, because you couldn't go out and you couldn't indulge yourself in any face-to-face services, though there were service sectors which did boom at the expense of others. For example, online shopping boomed at the expense of bricks and mortar retail, probably for at least half of it a permanent result, a permanent shift in the economic demand, but nevertheless a sawtooth of demand where during the pandemic online retail boomed, climbed up the sawtooth demand pattern of the mountain to the summit, and the bricks and mortar version declined dramatically. And now, of course, to an extent, that is going to reverse. But the main conclusion from this sectorial analysis is that demand for services, face-to-face services, depressed the service sector of the economy dramatically during the pandemic. And once the pandemic is over, then people thirst for the pleasure of being in each other's company. They go out, they use face-to-face services enormously, and you get a sawtooth of demand, which actually is working at the expense of manufacturing production. Manufacturing production has actually fallen to something like a 4% annualized growth rate from double-digit annualized growth rates at the beginning of the recovery from the pandemic, which is now, in a sense, a sawtoothed pattern which has gone over the top of the mountain. And we're seeing services, which is 70% of the economy in most economies, 60 in the highly manufacturing economies like Germany or Korea. But these manufacturing sectors are now on the downside of the sawtooth recovery, rejoining a trend growth rate and experiencing sharply falling growth. And the face-to-face services are booming. And they're on the upside of the sawtooth demand and supply curve, and will lead the economic recovery in the next phase, preventing the downturn in manufacturing becoming a concern about global aggregate output. So that, in a sense, is the nature of the sawtoothed cycle and why it is so different to any other cycle that we have seen so far. In terms of what does it matter? Well, it matters a great deal. For example, as the US growth rate declines and as Europe's growth rate accelerates, then you will see quite possibly a recovery in the euro from its very weak level of 118 against the US dollar for some period of time, because at the moment it is relative growth that is driving economies. You will see central banks continuing to intervene to smooth this pattern, and they will claim any excuse as justification for continuing to print money. So while they will print the money and buy government bonds and hold down yields, in reality, it is quite likely that we will see both US yields and European yields starting to rise, but with a different tempo, which will be set by the relative growth rates of the two economies. And finally, if you are an equity investor, then you have to think very carefully about where every sector you buy, indeed every company or corporation whose shares you buy, where they are located in this cycle. Because if they are on the upside of the sawtoothed recovery, then the earnings news will be good. But when they actually cross over the summit of the sawtooth and start to head down towards a more modest level of trend growth, then their growth will actually become negative. In other words, while they're rejoining trend growth, the growth will not be growth at all. It will be negative, and that will impact margins, because input inflation is established worldwide, not just in America. Input cost inflation is established worldwide. And as their growth rate comes down, their costs will continue to go up, and therefore their margins will decline. At the same time, as the likelihood is that long-term interest rates at least will be increasing the discount factor for equity multiples. So it is very important to apply this sawtoothed type of analysis to your global equity portfolio, but within that, to each sector, where is it located in the sawtooth pattern? And within that, to every single equity corporation in which you're investing, to know where they sit, whether it's in Europe or the United States. They might be in the same sector, but be in a very different place on the map of this economic recovery, which, as I say, is called sawtooth. Thank you very much for watching wherever you are, and have a good day.